Hello everybody and welcome back. It's Evan Clementino here from CBBB, and today we are going to be talking about write-offs. You hear it all the time. Someone buys a new truck, an expensive piece of equipment, and they say, don't worry, I put it through the business, it's a tax write-off. I mean, they're not wrong, but what does that really mean? That's what I want to explore today. We're going to cover exactly that question. What is a tax write-off? And I'll explain it through an example. We're going to look at an example breakdown of kind of what the value of a tax write-off really is, so you can really understand how much it's worth and how much benefit it is to you. And then I'm going to talk about the CRA for a little bit and talk about the conditions of write-offs as it relates to an expensive truck purchase. So let's get to it. Today we're going to be using the whiteboard, and the first thing I want to cover is a write-off compared to what you may be more familiar or comfortable with is just a personal expense, right? So if you own a small construction business and you're thinking you want to buy a truck, you have the option to do it on the personal side of things. And we know how that works, okay? You make your income and then you pay tax on that income, and that's your net income, right? On the personal level. And then you buy the truck, let's say it's 100K. And you pay HST on that, so another 13K in HST, and then this is your net income after expenses. So you can see that before you bought the truck, you had to pay income tax, and then you bought the truck and you had to pay HST on it as well. Now, on the business side, the real advantage to putting a purchase through the business is that in the business, you're only taxed on your profits. So it'd be income minus expenses, which is the truck, equals profits, minus tax on the profits, equals your net income after tax. Now, right there, you can see that the real advantage is buying the truck with your pre-tax money, right? Your purchase comes before the tax, and that is where the realm of write-offs exists. So what I'm going to explain to you now is what actually, like where the savings actually come from on this expense level and in this tax level. So let's look into that. Step 2 here. Okay. So the first thing we're going to look at is the impact that a truck purchase has on your income tax savings. And that's the write-off value on the income tax side of things. So as I mentioned earlier, you're taxed on your profits. So an expense like a truck would take away from your profits, meaning you don't pay tax. You don't pay as much tax because your expenses have increased. How much tax are you saving? Well, the value of the truck is $100,000. And you apply your tax rate, which for the purpose of the example, we'll just say it's 15%. So the taxes that you would have paid that you're no longer paying is $15,000. Okay? So you're experiencing $15,000 in tax savings. But according to the rules of depreciation, you cannot claim those savings within 1 year. Right? As mentioned in my previous video on financing versus leasing a truck, when you make an expensive asset purchase, the value of that purchase must be spread out amongst the lifetime of the asset. So you cannot claim $100,000 worth of tax deductions or $15,000 worth of tax savings in that first year. It needs to be spread out amongst the duration of ownership. So in the first, you basically break down this $100,000 into year 1, 2, 3, 4, 5, and so on until you sell the asset. What that means is that you're not going to save $15,000 in the first year that you buy that truck. You're only going to save, maybe it's $2,000. I don't know the exact math, but maybe it's $2,000. The next year it might be $3,000. And then it kind of jumps down to 1.5K, maybe 1K, 750K, something like this. Those aren't perfect numbers, but the idea is that the government makes you spread the tax savings of that purchase over time. So you will save $15,000 in taxes, but not immediately. It'll be spread out over the duration of owning that truck. That's income tax, okay? Let's make a note on that here. That's income tax. But what about HST? And that's one that I think actually gets overlooked, but provides the most value. So if you're paying for a truck that's $100,000 and HST here in Ontario is 13%, well, that truck's actually going to cost you $113,000. But the way HST is calculated and paid in a business is the net of all the HST collected on your invoices minus paid in your expenses. So let's say in this quarter or this year, for example, you owe $25,000 or you've collected $25,000 in HST, but you made the truck purchase and that charged $13,000 in HST. Well, you're only going to pay $12,000 in HST. So there is actually an immediate tax savings on the HST front, and I think that's going to be what you see as the biggest advantage for writing off expensive purchases in the business. You have the HST savings at the moment that you purchase that truck. You're going to pay $113,000, but you're going to pay $13,000 less when it comes time to pay your HST bill. So far you have the income tax savings of $15,000 plus the HST savings of $13,000 for a total of $28,000 in tax savings. That's the value of the write-off right there. So there's the breakdown with an example of what the write-off value of a $100,000 truck purchase is. As you can see, you don't just get a truck for free. You're basically saving on the income tax and the HST, but notably the savings on the income tax are spread over the cost or over the lifetime of the asset according to the rules of depreciation. So now let's look at the CRA's perspective on all this, just so that you know the rules around 100%, like claiming 100% tax write-offs for purchases like this truck. The first one is that in order to get 100% of the tax deduction benefits, you need to be using it for 100% business use. If there's anything that indicates that you are not using the truck for 100% business use, the CRA can question the claims of the 100% tax write-off and look into the usage of your vehicle. If they determine that you're not using it for 100% business use, they can claw back all those tax savings that you've received over the past 7 years, which are subject to tax audits. So you really want to make sure you're adhering to that 100% business use rule in order to claim 100% tax deductions. So how is the CRA going to determine whether you're using it for personal or business? Well, you're required to keep a mileage log. And there's apps that can do this, or you can do it from like on paper and keep it in the glove box. But essentially this mileage log is supposed to track every time you put mileage onto the truck. And if it's for 100% business usage, these miles are going to indicate that you're driving to a job site or to the hardware store, or you're picking up materials in a different city, whatever. But as soon as the mileage log indicates that you're taking that vehicle on vacation because it's the only thing that can tow your boat, or you're driving it to your mother's house as she lives out of town, the CRA is going to pick up on the fact that these aren't business miles, and then they're going to dig into the true business usage. And again, like I said, they can claw back if there's any indication that those are not used, it was not used for business purposes. And then number 3 is on the classification of the vehicle. So different types of vehicles are treated differently for tax purposes. And really, the notable difference is the qualification of a passenger vehicle versus non-passenger vehicles. So I'll just run through it quickly here. There's 3 classes. There's class 10, or 3 classes that I want to focus on. Class 10 is for your light trucks. Let's just call them the 1500s, okay? And then there's class 16 for the heavy duty trucks. Let's call them the 2500s and above. Those are clearly business use vehicles, right? Like it's really easy to make the claim that you're using them for business purposes. You know, you're towing trailers, you have the crew cab to drive the guys to site. These kind of things indicate that the truck is needed for business use, and you can more easily make the claim of business use and not personal use, right? But then there's a class 10.1, which is for passenger vehicles, okay? Now, if the CRA determines that the vehicle purchase is used for transporting passengers, right? Like if it's a sedan, well, you can't really use a sedan to tow trailers or to pick up materials, large materials, right? So it may be harder to make the claim that this is for business use, and they might indicate that, okay, maybe it's business use, but the business use case is for transporting passengers around. Now, I'm making that one notable because you can only write off $36,000 if it's classified as a class 10.1 vehicle. So we covered the example. You can see that just because the truck's $100,000 doesn't mean you get $100,000 in savings. Then we covered a little bit of the rules around what the CRA might think or how they might determine the full deductibility of your purchase. So let's just recap things quickly here with 3 main takeaways that I want you to grab from this video. Okay, takeaway number 1 is that a truck that's worth $100,000 in write-offs doesn't save you $100,000. If the write-off is $100,000, you're going to save the taxes on that $100,000. So you're going to save the income tax plus HST. Number 2 is the rules, okay? You're going to have to do a mileage log. Guys, it's mandated by the CRA that you keep mileage log. And it's going to be a real pain in the ass if you get audited and you have to go doctor up a mileage log in order to work with your estimates and your invoices, your job site locations, your gas receipts. It's going to be way easier to just be honest about your true business usage mileage. That way, when if an audit comes your way, you're prepared and you're not subject to some hefty tax clawbacks that could be tens or hundreds of thousands of dollars. The other one is on the classifications. You're going to want, this is more of just a side note, but you're going to want to understand what the real tax implications are of the specific vehicle that you buy. There could be some differences between a light duty and a heavy duty truck, but more importantly, you just don't want to be buying any vehicle such as a passenger vehicle and then be limited at only $36,000 in write-off value, which would be only like 10 grand in actual tax savings. And then rule number 3 is that an expensive truck is still an expensive truck. If you can find a truck that's worth $60,000 instead of $100,000 and it provides the exact same value to you in your business, well, sure, you might not save as much in taxes, but at the end of the day, you're gonna have more cash in your bank account to be strategic with and to protect your business moving forward. So there you have it. Next time you're thinking about making an expensive purchase through the business just because it's a tax write-off, you can understand exactly what you are saving and what the value of putting it through the business is versus putting it through the personal side of things. If you like this video, check out my truck financing versus leasing video. It's very similar. It'll help you make a decision on what to do. There's also some other videos on the income statement, how to read the income statement, and really interesting ones on job costing, so you can really maximize and understand your profitability to start being a strategic business owner. And that's what I'm all about here. I want you guys to be equipped with the back-end knowledge so that you can grow your business sustainably and achieve growing profits over time. That's all for now. I'm Evan Clementino at CBBB. Please subscribe to my channel. You can follow me on Instagram at Clementino3B for short form versions of these videos. Like and comment. And otherwise, I'll see you next time.